All right, everyone. Welcome to the first screencast for Chapter 8. In Chapter 8, we're going to start digging into that supply curve side of the economy. In this chapter, it's the first time we're really going to depart from our traditional supply and demand diagram and start looking at other kinds of graphical models that economists use to look at, in this case, the supply side of the economy. Or more, we're a micro class, so not really the supply side of the economy, it's really more the supply side's decision-making process. How do firms go about making decisions? It's still going to be pretty stylized, we're still going to assume away a lot of things, but just like with the supply and demand diagram, which is useful for a lot of things, maybe not every case we would want to look at, these, the cost curve approach, which is kind of the approach we're going to have in this chapter, doesn't capture every firm in every situation, but it gets us a long way, and there's a lot of insight for a somewhat simple model. It's a little more complicated, and it can be a little tough to go through, but I tried to split this up into several screencasts so we can go through it slowly. All right. So the first thing we want to talk about is, well, mostly what this whole chapter is going to talk about is business decision making. How do firms make decisions? All right. So consider a fast food restaurant. It needs lots of information because it has to make lots and lots of different decisions on what to do. All right. So the firm will use labor as an input. It'll have workers that will provide labor, and they'll have different shifts, and they'll have to decide how to schedule them and how much to pay them. All those sorts of things on with labor, which is one of the inputs into the firm's process. The second is capital. So these are usually machines, fryers, milkshake machines, cash registers in the case of this fast food restaurant. And then they're going to have other kind of inputs, food supplies, napkins, tables, other inputs into their production process so that they can then at the end of the day make sandwiches or coffee or whatever it is that the firm makes, right? So we want to talk about firms' profits and losses. And so economists have a little bit different way of thinking about profits and losses than you may have thought of before, just in terms of your everyday interaction with firms, or maybe you've run a firm, or you've run a business or a small business. Economists, of course, we always do things a little bit differently. So we're going to kind of have a specific vocabulary. So it's important when you're studying for the class and when you're taking the exam to always use the words as we use them as economists in this class, all right? So the first one is total revenue. So it's the amount a firm receives from a sale of a good and service. So it's simply the price of the good times how much they sell. Price times quantity is the total revenue, right? The next is their total cost. So this is the amount that a firm spends on labor, capital, and other inputs, right? How much do they spend on their inputs in order to produce the goods and services that they then sell at some price to give them the total revenue, all right? So profits or loss for the firm is total revenue minus total costs, okay? So profits occur when total revenue is greater than total cost. Losses occur when total revenue is less than total cost. So I mentioned already that the total cost are the cost of labor, the cost of capital, and the cost of other inputs. Economists consider one of those other inputs opportunity cost. All right. So first, let's go through what we call the explicit cost. All right. So these are tangible expenses. The wages you spend on labor, the rental price of capital or the purchase price of capital, insurance, your raw materials, your raw ingredients that you buy to produce your products. Those are all explicit cost. And then we have implicit cost, all right? These are the opportunity cost of doing business, all right? So there's going to be an opportunity cost of capital, meaning what is the next best thing you could have done with the money that you spent on capital? Or we usually think of capital in terms of a rental rate, meaning what if you were renting that capital, how much would it cost? Just because we want to make it comparable to wages. You pay wages constantly, and so we turn the cost of capital into a rental rate usually. But that's what could you have done with all that you spent on capital? What's the next best thing? That's the opportunity cost of capital, All right. Maybe you could have brought a franchise for a large sum of money. How could that have been invested otherwise if you had bought a franchise? All right. And the next is the the opportunity cost of the owner's time above the salary paid. So the idea here is that how much could the owner get paid if they just went and worked somewhere else? Okay. So those are going to be our two implicit costs: the opportunity cost of capital, the opportunity cost of the owner's time above the salary paid. So again, just to give you a few examples here, what are some explicit costs? Well, the electricity bill that you have to pay to run the business, advertising in the newspaper, employee wages, these are all explicit costs. All right. What are implicit costs? Well, labor of the owner who works for the company but doesn't get a salary. That's an implicit cost. The capital invested in the business is an implicit cost. The use of the owner's car, computer, other personal equipment to handle business, those are all implicit costs. And economists, we want to count these costs. All right. When we're talking about profits, we want to count those kind of costs. Now, in accounting or in the business world, they don't always consider these costs. I mean, they consider them in their decision making, but they don't always count it when they're deciding how much profit did I make. All right. So the profits economists talk about are usually a little different than the kinds of profits that firms or accounting classes or business classes usually talk about. All right. So let me define that first. That common use of the idea of profit we'll call accounting profit. It doesn't take into account implicit cost of doing business. So accounting profit is just their revenues minus their explicit cost, right? Like how much did you pay for the machines? How much did you pay for the wages? How much did you pay for your raw ingredients, right? Economic profit is a little different. Economic profit considers all the costs, both the explicit cost and the implicit cost. So economic profit is revenue minus all of your costs. So why would we want to take into account the opportunity cost of, say, buying capital, right? Well, it's because of this. If you didn't buy capital, you could have invested it in stocks or bonds or a savings account at a financial institution. So there's always an opportunity cost when you spend capital on your own firm. You could have put it in a very safe investment like a bond and gotten 3%. And this is the historical average rate of return since 1928, adjusted for inflation. All right. You could have put it in a savings account, which is almost a guaranteed thing in terms of the percent return, and gotten 2% on average. If you'd put it in stocks, you would have gotten 6% on average. So there is a cost to buying capital for your own business because you could have just parked your money either in stocks, bonds, or savings accounts, and you could have done better. So this is why economists want to count these kinds of costs, because if you don't take these into account, then you may be running your business and say making 1% return, and maybe it would have been better just to put the money in a savings account in terms of just purely how much you made. All right. So accounting costs can sometimes be misleading if they don't take into account these sorts of opportunity costs. So we want to count those as. So here's an example of the accounting profits for, say, our fast food restaurant. So we have revenues of $8,000. The workers' wages are $4,000. Insurance and rent is $2,500. Food ingredients are $1,000. So we have $8,000 in total revenue minus the explicit cost, minus $4,000, minus $2,500, minus $100. That's $7,500. Gives us an accounting profit of $500. All right. But economists want to count these two other costs down here. We want to count the implicit cost of the owner's time, and we want to count the opportunity cost of the owner's capital. All right, so that's 300 more and 400 more. So this firm was actually running negative economic profit, but positive accounting profit. All right, once we took into account the owner's time and the opportunity cost of capital. So again, I just want to drive this point home that when economists talk about profits, I'll try in this class to say economic profits as a reminder to you. But when we're talking about profits, we're not talking about just how much money do I have left over after I have revenue and I pay out my expenses. All right, that's accounting profit. We also take into account the opportunity cost of the owner's time, opportunity cost of the capital that you bought, and things like that. All right.